up, down, left, right, and sideways. The market is just doing whatever it wants right now. And if you want to get a better grasp on it, you have found the right place. You have found Riz International. And tonight we are joined by the man himself, Rizwan Memon. How you doing tonight, buddy?
I am doing great, Chris. Thanks for having me on. It's been a few weeks since I was last on, and it's looks like the markets continue to be a bit of a petulant child, if I may. So it's good to at least be on and hopefully break some things down and provide some insights.
Yeah, to say it's been a few weeks is kind of an understatement in my mind. It has been a wild couple of weeks in the market, and if you've been watching our webinar replays, make sure you click that like and subscribe button down below. Be part of the online community here on YouTube, but if you are part of our elite membership, you're getting this live right now here. I really appreciate each and every one of our live members here on the call this evening. And let's kind of take a look at things and break things down. So to say that it was kind of an up and down week is a bit of an understatement. We kind of started the week with a test of 4,100. It bounced very solidly, ran right up to 43. Everybody thought, this is it, we're going to keep going. And no, 43 held as resistance, and we rejected off of that, and we came back down. We tested 4,100 again. And I'll be honest with you, I was watching the market during the day, and I was just beside myself with the price action. It was ridiculous. I thought we were going to close below 4,100. I mean to say, Riz, give us an idea what is going on here with the market. This is just crazy.
Yes, volatility continues. We're seeing the VIX over 30, 34 even at one point. I don't see that shaking up too much, although I will explain our little bit of our VIX related bet in the later part of the webinar. But yeah, I myself thought, you know what, I think the way the price action is looking on Friday, we could see below 41 and stay there. But it didn't. To kind of recap what happened throughout the week, like you said, Chris, we had a nice start to the week. And Monday, a little bit of a pickup, from 41.23 or so. And then it looked bullish. It looked bullish. And then we had a little bit of a catalyst, if you want to call it little. We had the Fed, uh, you know, FOMC decision, Federal Open Market Committee decision on rates. And of course, as expected, they did a 50 basis point hike, so 0.5% increase from the benchmark rates. So that means total year to date interest rates from the benchmark rates are up 75 basis points, so 0.75%. And of course, the market expected this. In fact, the markets were very jubilant on Wednesday after the rate hike and after Jerome Powell, Fed Chair Jerome Powell said, okay, we don't plan and we don't have 75 basis point rate hikes on the table. So market took that as a very positive thing. Again, remember, increased rates usually means, we're trying to cool off the economy, and in this case, specifically inflation. So market took that as a positive on Wednesday, and it almost felt like, wow, this is it. This could be the bottom, and we could be on our way to 4,400 and up. Well, guess what? Not so fast. Thursday was a complete reversal, and it just kind of chop into this kind of back and forth. It's extremely difficult to trade through. No matter what anyone tells you, yeah, you can make some money for sure, but doesn't mean it's easy. Doesn't mean it's common. So with that pullback on Thursday, we had a continuation lower on Friday. Although Friday, that candle, it's very, very indecisive. Tells you how difficult this market environment is to read from one day to the next with those candles and wicks, right? So ultimately, the market did close in the red, about 50 basis points, or like 0.5%. And here we are, right at that 4,100 area. You could classify this as a double bottom, meaning the market has touched this area before, in fact, right at the start of the week. Now we need to make sure that, or we need to see if markets can carry this area, stay above it. If it goes below, then as I've said before in our in the elite chat, in the guidance tab, I've said that, look, if we go below 4,100 in a bearish manner, we could very easily see 4,000. I was right a couple weeks ago when I said, a break below 4,200 could see a rapid drop to, sorry, a break below 4,400 could see a rapid drop to 4,200, and that's exactly what happened. And here we are. A couple weeks have gone by, and we are still below that 4,200 level. So very much cautious environment. I'm not recommending anyone to just go and buy everything. I mean, for those of you in the elite membership, whether you've been with us or you just recently joined, I have released that tiered conviction buy list. Now, that doesn't mean that you just go in there and buy everything, blindfolded. You pace yourself. Make sure you have capital um, on hand. Make sure if you're buying on dips. You're buying in a small, calculated fashion, and you're not just going all in the market. Because just because I released that list doesn't mean the market can't go lower, or doesn't mean that there's no downside. I do genuinely think that if this continues, uh, we could see 4,000. And if it breaks 4,000 level, well, look out below, because at that point, we are in a bit of a pickle, so to speak. And I think 3,800, um, you know, could be the next area. And that would actually, Chris, if you don't mind, from the peak, once you're done with that, the peak, uh, January 4th, I think it was, or something in the market, from the peak to now, or to 3,800, what would that be? I think it would be just about 20%, 21% in the S&P 500 drop. So would you look at that, 21 and a bit percent? So that's crazy. Chris, where are we at right now? Probably around 15, almost 15. Look at that, right? Chris, my finger on the pulse is there, is it not?
Dude, your mental math is always there when it comes to determining market movements.
Yeah. So this seems to be the kind of area you want to be aware of. Again, don't be afraid, don't be panicking. Just be aware. This isn't the end of the world. We're not facing an end of the world situation. We're facing, a potential bear market. In fact, speaking of bear market, the Nasdaq, Chris, if you go, shoot, what's the Nasdaq symbol? I have it on mine, but IXIC. Try that for the index. There it is. So here's the Nasdaq index. Again, we primarily look at the S&P 500, or I do. I prefer that as a broader, better gauge of the market environment. But the Nasdaq is, of course, the pure tech index. Now, this one, if we look at the peak, Chris, you'll see we're beyond 20%. And this is around 25% right here, as Chris has highlighted. So this is already in bear market. In fact, the Nasdaq continued to look even weaker. So of course, tech stocks, are not an ideal place to be in terms of exposure. But hey, it's fine if you carry the large cap, solid companies. What you want to make sure is you're not strapped for cash. You're not, margined up to the hilt. So be very cautious of that. Keep some dry powder, so to speak, so you can deploy it when and as opportunities arise.
Now, Riz, you use the term bear market, and I think we hear a lot on social media and alternative media, and even sometimes the mainstream media. They use the term recession. What's the difference between the two of those?
Yeah, I'm glad you asked that, Chris. So bear market in a definitive way just means 20% or more decrease from the highs. So, Chris highlighted that just recently with the Nasdaq. Um, the S&P 500 not quite yet in the bear market, although price structure, price action, and technicals point that could be the case. So anything 20% and below in the market indexes is a bear market. The recession, though, and a lot of people, confuse the two. They're separate. Sure, they're related, but they're separate. A recession is usually, again, the definition is a bit varied, but really it's 2 or 3 consistent back-to-back quarters of negative GDP. So, for those of you paying attention, we just had a recent GDP print not this week, but the week prior, and that was a big miss. That was negative. I believe it was negative 1.4%. I think. Um, so that's the first month. If we have another, not first month, but first quarter, if we have the next quarter print be negative, oh boy, that could mean we're in a technical recession. A third quarter cements that, in my view, a third consecutive quarter of negative GDP um, means that the economy is contracting. And a contracting economy means many, many different things. But usually we see the stock market leading. It's the stock market is a leading indicator for the economy. So when we see bear markets occur in the stock market, more often than not always, but more often than not, we see recessions occur. Okay, now before everyone throws the baby out with the bathwater, I will tell you bear markets and recessions are a completely healthy part of a functioning economy, of a functioning stock market, of a functioning capitalistic system. Okay, this is something that needs to be ingrained in people. I know many are aware, but they seem to forget. They seem to panic or go into whole doomsday mode. This is actually a completely healthy part of the economy. It needs to happen. We can't have years like 2020 and 2021 all the time. It's completely unhealthy. It's not normal. And in fact, it can be really bad, as we see, for broader economic health. The reason we're dealing with so much inflation and this whole problem with inflation is that, we had way too much money injected into the system. And I've been saying all this for a better part of, 6 to 8 months now. I've been saying way too much money printing, way too much, stimulus, way too much fiscal spending, way too much of a deficit, um, and way too low interest rates for too long. And I don't need to keep repeating myself, but ultimately, because of that, we are here. You don't have to be a genius. We've seen prices go up, whether it's at the gas pump, whether it's at the grocery store, whether it's buying, um, pretty much anything, from houses to rental costs to cars, everything. So this is what happens when you have a very, very overheated economy, when you have money that is very easy to borrow, when you have funding and you know cheap credit. This is what happens. And uh, the Federal Reserve and the people at the Fed, the economists, although that word doesn't mean much anyways nowadays, are have been asleep at the wheel. And here we are at I've been saying this for um, almost seems like years, but hey, here we are. Uh, Now the biggest thing I can tell you right now is going to be the next inflation print. I don't have the date on top of my head here, um, but the next inflation print is going to be critical to where the market is and how it hangs on, because it's hanging on by a thread right now. If we have inflation stay above 8%, or God forbid, go higher towards 9% annualized or up or further, that is going to be a big disaster for the market. So that's something we need to be aware of. I will provide more guidance and details to elite members, in real time as I see them come in, um, on how to position ourselves. But on the flip side, looking at things on the glass half full side, what if we get a good inflation print? Meaning, inflation is not going to be 2%, 3% annualized, no way. But what if it's below expectations? What if instead of the 8.4% or whatever it is at now, what if we come in at 7? What if we come in at mid 7%, or even better, low 7% or high 6%? I doubt it, but what if we do? Well, that's going to boost the economy. That's going to not boost the economy, but that's going to boost the market. Sorry. It's going to give the Fed some reprieve. It's going to give them the idea that, oh, okay, this cooling off of the economy, the higher interest rates, higher borrowing costs, trying to combat inflation with that is potentially working. So that's the two scenarios you want to look at. As a trader and an investor, you always want to look at it from a if and then statement. Okay, if this happens, then that can happen. If scenario A happens, this is what could happen. If scenario B happens, this is what could happen. This is how you want to look at it. No one can tell the future. No one can be right all the time, and no one knows for certain. Not even the people in charge, quote unquote, of the economy. Whether it's the Federal Reserve, whether it's the economists, whether it's the White House. No one is in control of the economy, and no one can tell the future, no matter how many PhDs they have, no matter what. Okay, so all we can do is work with what we have, and of course, as an elite member, you will be. I can assure you, much better off, much better prepared than not only the average person, because you're already way better off, way better prepared, but I would argue you're going to be much better off and better prepared than the majority of investors and traders in the market. This is the difference. This is the edge that you have as part of being an elite member. And if for those of you watching the recording after the fact, and you're not an elite member, um, and you missed, if we just opened our doors, if you missed the chance, you know what? I know there's some stragglers or some people that are a little bit behind or been busy. Just shoot me an email and we'll get you sorted. But we are closing and have closed the doors um, for the time being.
So obviously nobody puts baby in a corner. That's the underlying message as to who's controlling the economy. But I wanted to pose a real quick question, then we'll move on. Let's say we have one of those less than favorable inflation prints. Let's say, for example, at that point, Riz, do you think that a 75 or even 100 basis point rate hike is on the table, even though Powell said that it wouldn't happen?
No, so about a 1%, no. A 75 basis point. Well, the market is already theoretically pricing this in now because of the complete reversal we saw from Wednesday's rate decision, and when Powell said that 75 basis point rate hikes are not on the table. The market said on Thursday, nah, we don't believe you, to put it simply. So the market is just like when the Federal Reserve and all these economists were saying, oh, inflation is transitory, it's not permanent, it's only a hiccup, it's only a blip. Well, they were wrong completely. The market is now effectively discounting and just brushing aside what the Federal Reserve says. So they are actually factoring in a potential 75 basis rate hike, uh, whether the next meeting or the meeting after. That is a side of the inflation print. If we get a bad inflation print, okay, so like you said, if it's above expectation, above 8% or so, well, that's almost a given. It's almost a guarantee that the Fed's gonna have no choice. In fact, they're already kind of in between a rock and a hard place because they have no choice. They have no other tools to cool off inflation, to bring down and calm down the economy from running too hot. They have no other tools besides raising rates. And this is the problem because they used everything in their arsenal and they kept pretty much everything in their armament already was used over the last couple years and more. So they kept doing quantitative easing. They kept buying up bonds and corporate bonds and treasuries, to ease and provide credit. They kept interest rates low, 0%. In fact, real rates were negative if you factor in inflation. So you actually got paid theoretically to borrow money. They did all these things for way too long, and now the only choice they have is to uh, reverse course. And I can assure you that if we get a bad GD preprint, the market will uh, pull back further. The market will then start pricing in uh, maybe more than one. 75 basis point rate hike. I don't see a 1% as of right now, but 75 basis point is potentially on the table. Just like in the beginning of the year when people were like, okay, we're only going to see 25 basis point hikes. Guess how that changed, right? The market then started pricing in 50 basis point hikes, and we just saw our first one on Wednesday. So this is the beauty of the market. We can, again, it's a art and a science, but again, I live for this stuff. I've been doing it my entire adult life. So for me, it comes easy to be able to channel and kind of decipher what the market as a collective is doing and anticipating. And what Thursday told me was the market does not believe a single word of Jerome Powell and the Federal Reserve as a whole.
Always comforting. All right, let's take a look at here at the breakdown of the S&P 500. And I find this week kind of interesting, to be honest with you, because I see some, some disparity between things that we're seeing. Because, I mean, you look at it, it went hot and then we went cold, just like Katy Perry. But energy is just hot. It is just going up 44.91% on the year. Holy cow. Utilities also bouncing up off the zero line here, but everything else is down below that zero line. The SPY ETF, representing the S&P 500, down almost 14%. Tech getting hammered, almost down 20%. So obviously the price of oil somewhat plays into this energy hike, Riz. But like, what are you seeing here? Is this something that we need to be concerned of, about the fact that energy is going up while the market's going down, or is there something else going on?
It makes sense in a way because Europe just a few days ago and last week mentioned that they are going to be getting off of Russian oil. So Russia is one of the largest suppliers, net exporters of oil, and of course Europe is very much dependent on Russian oil. So uh, they don't want to, but they're kind of forced to, for optics and many other reasons, get off of Russian oil. They can't do it right away, like the U.S. has done, like Canada has done, but they are promising to do so by the end of the year. So completely get away from Russian oil. So this is causing more of a bottleneck. This is bidding up the price of oil even more. Hence why we've now seen the S&P 500 energy ETF go even further. And this is, of course, a risk because as we have oil prices above, I think, 105 US dollars per barrel in WTI crude, that means, you know what, inflation isn't letting up. I can assure you, if the oil prices, went down to 90, $80 per barrel, that will ease a little bit of the inflation metric because prices at the pump, gas prices, oil prices are a partial factor in the calculation of CPI inflation. So this doesn't bode too well. But in regards to all the other sectors, makes about sense, just sounds about right, kind of moving down alongside the S&P 500. Utilities, the reason utilities is above 0% is utilities and commodities like oil, and a few others usually tend to be safe havens. So when money isn't completely removed from the financial markets, it's not, completely liquidated, sold, or taken out and put into something else. It's usually shifts towards things like commodities, things like utilities, and even to a certain extent, um, uh, some REITs and maybe even gold. Although gold has just been kind of treading water. But for the most part, none of this is surprising. I continue to see this type of uh, trend continue into the next week, uh, and maybe even in the coming month, because right now we need some, I would say, some direction in regards to inflation before we could see any potential in, uh, you know, trends.
When you leaned right into it for me, talking about the price of oil and gold, of course, and if any of you were on webinar last week, you may recall that I made a somewhat bold prediction that I was bullish on oil, and well, I hate to say I told you so, but I told you so. With what Riz mentioned, the fact that Europe is trying to push itself off of Russian oil, it does push that price up. Looks like oil closed at 109.77 on Friday. So, a nice upwards push on oil this week. And gold doing its thing where it comes out of the channel and goes right back in. It's been doing this for years now, it feels like, since, let's see, back here in 2020. We established this channel here between this 1967 and about 1679, and gold just doesn't want to come out of there. It comes out for a little bit to play, and then just kind of goes back in. So we get a little gregarious with the price of gold, and it just decides, okay, let's cool off. But Riz, I know you're really have your finger on the pulse of oil more. Do you think that we'll see continued price, increase with this move from Europe, and if they, push it even harder? Um, Obviously, with things going on in Eastern Europe, that doesn't bode well for the price of oil. But what are you seeing as far as that's concerned?
Yes, so we could very reasonably see $120 again. Um, I think around anything above that, and even now we have somewhat of demand destruction, meaning um, as one of the biggest combatants to inflation, um, or very high increases in price of anything, but in this case specifically oil, is effectively demand destruction. So anytime you have something priced very high, the biggest combat to that is the high price itself. So the common term that okay, it's too expensive, we won't buy any. Although you can't really do that with oil too much because you need gas, you need energy, you need this stuff, to operate your day-to-day life for the most part. Um, so it's a bit difficult, but even with something as crucial as oil, it can happen. Where if a price is too high, um, we have already seen, people will drive less. We look at the data, people are commuting less already since the pandemic, but even more so with prices this high. We've seen people kind of start trying to button up their wallets a little bit more, try and be more cautious with how they spend. And it helps a little bit. It can't obviously completely counteract it, but we are seeing some demand destruction at these prices. I don't see oil prices above 120, 130 a barrel being sustainable with current demand prospects. The only issue comes is what if supply gets shut down? Meaning, if God forbid, if there's some kind of attack on refineries or producers, if there's further instability in the in around the globe, outside of Ukraine, Russia, then of course that's a different story. Um, but if we do see on the flip side an agreement or a peace talk or something positive in regards to Russia Ukraine conflict, guess what's going to happen? Oil is going to come right back down and below 100. You can mark my words on that. That's again, if it happens, it will come below 100 very fast, very rapidly. Um, but until then, uh, I wouldn't be surprised if we stay above $100 mark, and maybe channel for a bit here between 100 and 120, 115. But again, this remains to be seen. Personally, I don't have any direct oil positions. We have traded oil a little bit in the last few months, just the swings and done well. But so far, no oil position. And gold, I haven't traded for a better part of a year. It's just not appealing. In fact, it hasn't acted much of a hedge at all over the last couple of years. So here we are.
Yeah, absolutely. I think that's kind of the biggest surprise to me, that gold is just not, being that hedge that it used to be against inflation. You expect with the highest price or the highest inflation we've seen in 30 plus years that gold would be going nuts, and it's not. And so it just wants to stay in this channel. That just seems that's what it wants to do right now. So we're just going to kind of leave it be. Something that likes to move out of channels is Bitcoin. Just kind of taking a quick look here. I know we don't have any positions in cryptocurrency at this point, but Bitcoin taking a bit of a hit this week. Maybe a little bit concerned with those rate hikes as well. Not being able to push over that 40,000 mark and really coming back down. Riz, is there anything you hear about going on in the crypto space?
Yes, so this is not surprising. I know, I said, look, if Bitcoin can continue to trend upwards, it bodes really well for hitting past the 50,000 mark, but that clearly hasn't happened. It's broken down since last year and gone even lower than what I anticipated. And this is very bearish. The biggest problem is the the biggest draw to crypto and Bitcoin specifically was, look, it's a hedge. Look, it's a great asset class or something to hold when the economy is slowing down, when inflation is running high. Guess what? It hasn't panned out. It's dropped what I think, Chris, 44% or something. from the highs of 69,000, uh, 48% right now. So it's pretty much nearly half from the highs. How about that, right? To You have the US dollar weakening 8% annually because that's what inflation is, buying power decreases. And then on the flip side, you have something like Bitcoin, which is losing 50% in a span of 6-7 months. How about that for inflation? This is and also this is assumed like remember, Bitcoin is also deflationary, meaning there's only a limited supply of coins and yada yada. And look how that's playing out. You have one of the most uncertain environments in many many years, and when we have something that is supposedly supposed to be a hedge, supposedly supposed to be a safe haven, supposedly supposed to be a combatant to a weakening U.S. dollar, um, is still getting slaughtered. And hint, hint, the U.S. dollar is actually getting stronger. So here we are in a pretty much complete 180 to the you know thesis that all these people had. For me, I was skeptical, and I've been talking about it for quite some time that crypto is not a hedge. Crypto is actually very correlated with the market, and specifically uh, the tech sector. We've noticed that anytime tech stocks or the Nasdaq takes a beating, the crypto market and BTC, Ethereum, etc., gets slaughtered alongside with it. So a lot of correlation there between the two.
Not that you're opinionated on cryptocurrency or anything like that. Uh, Sorry, I had to throw that in there, guys. All right, so we have a couple questions come in from our elite members, and I want to go ahead and ask if you have questions. Go ahead, start typing them in the chat. I'll start with the order that I received them in, and then I got a big question at the end that we can talk with Riz about for a little bit. So this one comes from Steven. He says, I wanted you to take a quick look at CCO. Carnival Cruise Lines. Yeah, that did really good in COVID. I said they recently promoted a new CEO. They have relaunched 3+ cruise ships, but with the U.S. economy maybe going into a recession, there's the big R word, I'm hesitant. I have been writing puts between 14.5 and 15.5 strike because I believe that this is below the support of 16, if my technical analysis is correct. My time frame is around 2 to 3 years for recovery to the 25 area while writing weekly calls. Do you think that's a good play, Riz?
Right. So Steven has puts, Chris, you said?
Yeah, it says he's been writing puts between 14.5 and 15.5.
Okay, yeah, so he's shorting puts. Okay, so he's writing puts. So honestly, this is not something I like. I'm not a big fan of cruise lines. I'm not a big fan of airlines. This is not something I really want to. Yeah, maybe the premium there, but it's not a company that shouts fantastic, stellar business. And I'm not even looking at technicals, right? Look at the earnings they've missed. Obviously, because the pandemic's weighed on them heavily. But they're just consecutive misses. They're bleeding cash. They have these massive, massive assets that are just sitting away and just eroding. And yeah, I know their cruise lines have come back online recently, and they're added more and blah blah blah. But this is not a business really I want to be in. There's a reason why I don't do short puts in these. Otherwise, if you're at these levels, whether it's 14.5 or 15.5, let's hope you don't get assigned and have to take delivery. Otherwise, you might want to just take the hit if they are in the red. This is not something I'm too thrilled about taking. I would not want to take delivery on these or carry this because it's just at this point it's just dead weight capital.
Yeah, I got to say, you've definitely seen a decrease in the price of cruise, and cruising has definitely become less in vogue. And honestly, I feel like it was kind of that way even before COVID. It was not as popular as it once was. But the second part of the question is, do you think it can get back to the 25 area in 2 to 3 years? I don't know at this point. What are your thoughts, Rose?
Yeah, that's a bit too speculative, honestly. It very well could, because we've seen them, the price at least, come back up to this area, like we see last year, a year ago. But I don't see that as a given. It wouldn't be fair to assume that just because the price was there, last year or anytime recently, that it will come back. We need to see a complete shift in the industry because currently the earnings aren't anything to be happy about. So A price of doubling from here in the next year, sure, it could happen, but it's not something that I want to be uh, sitting around waiting for.
Definitely, yeah. Carnival definitely taking a beating here. Now, this one we actually answered half of this question already, but Vin messaged me. He said he has a couple questions for webinar. Thoughts on 3,800 being the next critical support point? Well, Riz already said that is the case if we drop below 4,100. But the second part I think is very interesting, and I think it would be very helpful for people. He wants to know, what signs would you like to see before you think that the market is finally having a reversal, like a full-on reversal? For example, seeing an upwards trend for X amount of days. Not sure if that's going to be it. But he says it's difficult for him to be confident that with the market's direction, with everything being so choppy. And I have to, mirror that. It's been really hard to get a gauge on it. But Riz, what would you like to see to say, like, okay, yeah, we're in a recovery now?
Yeah, I mean, it's very difficult to say beforehand, but I would like to see, a few bullish days. Again, price action will determine. We need also some catalysts to go our way. And of course, I touched on one of them being the inflation print, which will be the biggest one. The market, obviously, technicals matter, but the externals matter more. We need to know how the economy is doing. We need to know how inflation is doing. We need to know how job numbers and unemployment is doing, which are holding up pretty well, all things considered for now. And those will give us those broader directions. Right now, it's safe to assume, based on technicals, we could see further downside. I'm not saying 3,800 is going to happen right away or next, but we need to remain agile. We need to be open to the fact that we could see, 4,000 on the index level, and if that does occur and a break below that, maybe 3,800 is on the cards. And of course, as we touched on earlier, that puts us right in the bear market on the S&P 500.
Awesome. All right. Joseph has a great question. I have my personal favorite here. He says, NVIDIA or AMD for a long-term hold? What's your pick? Let's take a look.
Yeah, a great question. These, without giving too much away, these are two stocks that I'm bullish on. Um, I I feel like you can't really go wrong on either. They're both very high up on my list, but in terms of further upside, I would personally say AMD because um, they had recent earnings. They had earnings most recently, and they were great. Um, they they have the opportunity of taking more market share. Nvidia is already a leader, phenomenal company, but they have an opportunity of taking more market share. I feel like their next earnings will be important, and they're a few weeks away. So for me, if I had to pick one, AMD. Okay, Nvidia still has their earnings coming up in a few weeks. I think, Chris. I think that was what is that, June? Yeah, end of May, end of this month. So that will be an indicator. But as of right now, AMD, I really feel like it can't really go wrong with either for the long term.
That was my pick too. Honestly, I would prefer AMD for a long-term hold as well. Do you worry anything about the chip shortage or things like that affecting AMD, or is that something that you think is going to be less of
Yeah,
an issue?
it's already affecting pretty much every semiconductor, whether it's the end product like AMD and NVIDIA, or in the fabrication production stage like TSM, Taiwan Semiconductor, so on and so forth. It's pretty much impacting everyone throughout the entire supply chain. But they've been holding out quite well. There's no issue in terms of demand. The issue is supply and production. So they're doing well. We know at least their production is there. It's just not where they want it to be or where they can keep up with demand. But you know what? I think eventually, if not this year, going forward, it should play itself out.
All right, so I went ahead and pulled up the earnings that are coming up this week. Riz, what are you looking at? What's something that is like, I need to keep my eye on this one?
Yeah, so there's quite a few tech stocks, primarily the more growth oriented, the more smaller companies. Again, they're still large, but smaller companies. I'm sure many will be interested in uh, UPST, Palantir, and AMC. Of course, we have Peloton as well, who is in a bit of a pickle, and we have SoFi, we have Coinbase, Unity. Unity is one that I obviously have traded before, along with Coinbase. The Trade Desk is also another one that I'm interested in keeping an eye on. Uh, and of course, we have a few others like Beyond Meat, which is obviously not a tech stock, but Walt Disney. Disney is one of the ones that probably I would say the biggest or the most important one for me personally, as I do have a long position. Um, but yes, there's quite a bit for pretty much uh, everyone to kind of keep an eye on. But the larger, you know, multi like $1 trillion company, the market leaders, the big tech, they have all reported. So now we're into the kind of the final innings of earnings season.
Well, that's awesome. Thank you for that insight, Riz. Definitely a lot of tech stocks on watch this week. We'll have to keep an eye on that. Riz, what are your closing thoughts here? I mean, it's obviously been a wild week in the market. I'm hoping for quieter days, but I don't think we'll have them anytime soon. What are your thoughts going into this next week?
Yeah, I'm hoping that we get a little bit of a push up, little bit of a relief rally, just based on Friday's indecisive close. The fact that in power hour, so just within the last hour of trading, markets uh, did quite a bit of a recovery. Again, not a full recovery. We still closed red, but quite a bit of a recovery, as you can see from that lower wick below the 4,100. So this bodes well. So long as there's no negative catalyst, no negative news, I think hopefully based on price action from Friday, we see we see a bit of a relief rally. Um, and as far as middle of the week onwards, that remains to be seen. I feel like we're still in a bearish environment. As you can see, the trend points downwards. We've got a lot of volatility. And this is ideally a short term trader's environment. It's not easy, but that's the kind of environment it is. It's ideal for shorter term trading. Of course, there's amazing opportunities for investing as well, but that requires more patience and discipline and just letting it be. If someone wants to be a little bit more active in the market, place a few more trades, then it's definitely a market for a day trading style or a very shorter term swing trade, if even. So that's my kind of take on the market environment as a whole and what style is conducive. Because unlike you know common thought process, certain market environments lead themselves to be more uh, favorable to certain trading styles. And like I said, this one is more shorter term. There's been times in the last few years where it's been the opposite. It's been better for maybe buy and hold, and it's been better for even swing trading or position trading. So that pendulum swings. But right now, very much a short term trading environment. So if you can take advantage of volatility up and down, you can take advantage of rallies and sell offs in the near term and be agile, be fluid, it's absolutely a great time to be a trader.
Like I'm always fond of saying, guys, no one ever lost money by taking profits. So, I think that's really good advice with the markets being as choppy as they are over the last few weeks. If you've got profit or positions rather in the green, don't be scared to take those off and take the money and run, because you can't lose anything once you take your profits, because then you've gained them. So make sure you're capitalizing on those gains and make it happen, guys. Thank you everybody for coming out for webinar tonight. Really appreciate it. And a special thanks to you, Riz, for coming out and giving us your time. Really appreciate having you on the show.
Awesome. Thanks a lot, everyone. Awesome to have all our new members. And again, if you did happen to miss a couple day window that we had for opening and you really, really want in, just send me a message and we'll get you sorted. Otherwise, we will be kind of sealing the final doors shut for new members for the time being.
That's awesome. Welcome to all of our new folks, and we will catch you on the next one.